So my presentation is on inclusive finance and credit constraints. It's based on field work in Pakistan, which I conducted as part of my PhD study. The chapter which I shared with you is something that I've submitted to a journal, and then I got back for revision and resubmission. So it has changed a little bit even from what I shared with you, but the basic subject matter remains the same. And of course, it's very helpful to get everyone's comments and queries to improve it further. So let's begin. So here we are. So yes, so this is fieldwork that I conducted in 2017 and 2018. And my focus was on inclusive finance, not just as a poverty reduction measure, which is probably what I started out with. But over time, throughout the course of the fieldwork, I became interested in inclusive finance as a symptom of the global financial system. So two features which I specifically wanted to explore were firstly the relation between inclusive finance and the demand for yield from institutional investors. The other symptom of the global financial system which I was interested in is domestic credit constraints. So I wanted to see how this phenomenon of inclusive finance connects to these two tendencies. So the demand for yield from institutional investors is something that I link to the uneven nature of credit creation. I'll just talk about that a little bit. But the gist of it really is that there's an asymmetry in who can create money or who can create credit. So in the global north, it's quite easy to do that. It's quite easy for central banks and even private institutions to create credit. In the global south, it's not so easy. So as a result, what we see is this shift of investments coming from the global north into the global south. Now, this has been documented quite well in a number of literatures, but specifically for inclusive finance, I use a lens of shadow banking to explore this. I'm also interested in domestic credit constraints, and these emerge from something called the currency hierarchy, which I will discuss briefly in a little bit. And the currency hierarchy in the case of Pakistan operates through a few mechanisms. So one of these is inflationary pressures. There's also an imperative to accumulate foreign exchange reserves, and this entails high interest rates. So these inflationary pressures and high interest rates contribute to domestic credit constraints. And the case of Pakistan is one in which inclusive finance is specifically designed to address these credit constraints. So whereas there are structural drivers of credit constraints that are not addressed through the inclusive finance policies, the idea is that there is a means, or an alternative means, so to speak, to address domestic credit constraints. Now, just very quickly, I want to talk about the poverty reduction context, because this is normally what inclusive finance pertains to. So it's a widely used development intervention, and there have been a number of critiques. If you're interested in the critiques, you might have already come across Bateman and Chang's article of in 2012, and this draws on findings from something called the Duvendak report. So this was funded by the Department for International Development in the UK, DFID. And the Duvendak report is essentially a critique of, it's a systemic review. So it brings together all the reviews to assess the impact of inclusive finance or microfinance or microcredit, all of these terms put together over a few decades. And more recently, there's been a resurgence in critiques that are directed at RCTs, or randomized controlled trials. And this has really happened because Banerjee, Duflo, Kremer recently won the Nobel Prize in economic science. And this was quite an interesting decision. And it has a lot to do with their RCT strategy. And RCTs are considered problematic for a number of reasons. But one of these is how they've been used to sort of validate this agenda of microfinance. Now, the gap over here, the limited discussion has been about structural features of the global financial system. And I want to sort of expand on this specific aspect of the inclusive finance discussion. Now, this is just something that I put together for anyone who might be interested in asking what inclusive finance is and how it relates to other interventions. So there's microcredit, which is the earliest form of financial access for the poor. Then there's microfinance, which is a more evolved version, which includes other financial instruments as well. So not just microcredit, not just loans, but also insurance and savings instruments. Then financial inclusion marks this major shift that took place. And financial inclusion covers a lot of instruments and a lot of approaches overall. And it doesn't, the most important part over here is that it sort of opens up microfinance or microcredit to a large number of institutional investors. And then inclusive finance is the newest iteration. It's quite closely related to financial inclusion, but the digital technology aspect, I think, sets it apart. Now, before proceeding further, I just want to give a very quick introduction to shadow banking for anyone who's not familiar with the term. Now, shadow banking, by definition, is credit intermediation activities carried out by entities outside of the regular banking system. It's commonly associated with the global financial crises of 2007, 2009. And for a lot of people, it's a complex term, but very, very basically, it means this shift from a model of intermediation to disintermediation. So in this illustration, we see the very traditional model of banking. The traditional model is one in which you place a deposit in a bank, and then the bank lends that deposit to somebody else. And there's a fractional reserve element, obviously. So if you place a deposit, it can actually create more loans than the amount that you've placed. So that's the basic model of intermediation. Disintermediation occurs when you slice and dice those products, when you don't rely, when the deposit is not just to create loans, when the loans itself become products. So it's an it's a distinction rather between originate to hold, which is the traditional model, and originate to distribute. So the lending product becomes distributed itself. It's not just a loan, it's a product or instrument on its own, and it can go on in turn to produce more and more instruments. Now, the two key mechanisms that drive shadow banking in rich countries are the same as those in poor countries. So there's regulatory avoidance, and this came up a lot in discussions around the GFC. And the key idea over here is that it became harder to avoid regulation, to avoid restrictions on lending and so on, which is why bankers or investment bankers, institutional asset managers and so on became very, very creative with what sort of instruments they'd produce and sell and market and so on. The other aspect of shadow banking, the other mechanism, is the demand for yield. So there is this idea that there's a global savings glut, and this glut needs to be redirected to more and more instruments. So more and more instruments are created in a response. And we see this happening in the global south as well as the global north. And what I discuss over the course of these next few slides of this presentation is that inclusive finance meets both the criteria. So there's a regulatory avoidance aspect and there's a demand for yield aspect. And more importantly, it's a response to credit constraints. So it's a form of shadow banking that's created to counter credit constraints in the Pakistani banking system. Now, what are domestic credit constraints? So there are two assumptions, two notions that we have to be familiar with to understand. So first of all, it's the loanable funds assumption. Now, the loanable funds assumption is obviously it's a subject of a debate, and loanable funds theory assumes that deposits create loans, and it's not loans that create deposits. Now, when we say deposits create loans, again, we're referring to a very traditional model of banking in which somebody places a deposit in a bank and that deposit becomes a loan. The other, the counter argument, and this is became quite popular, particularly after this Bank of England paper from 2015. So this is the one I'm referring to. And there's a money creation debate over here. And the idea is that banks are able to create money not by gathering deposits, but the loan creates a deposit and it reverses the equation. Now, for developing countries, and this is important to clarify over here, since we're talking about Pakistan, which is a developing country, an ILF, which is an intermediary of loanable funds model, is appropriate because the choice of model depends on whether or not the relevant stage of banking and development has been reached. So Victoria Chick and Sheila Dow have this very useful publication on the stages of banking. And in that, they show that this idea that loans create deposits and not vice versa happens when countries or economic systems reach an appropriate stage in their banking trajectory. And for developing countries, this has not yet been reached. So for now, we proceed with an ILF or loanable fund set of assumptions. The other aspect of it is currency hierarchy, which I will just discuss over here. Now, the currency hierarchy is a Keynesian concept, and it's inspired by the notion of rate of return and the liquidity preference theory, which comes from Keynes. In more recent publications, Bortz and Kaltenbrunner, for instance, have identified that within the currency hierarchy, the country issuing the main currency has an exorbitant privilege. So over here, you can guess that we are talking about the US dollar. Now, the reserve accumulation imperative is something that they discuss as well, but it's been discussed quite extensively, particularly in relation to what happened with the East Asian crisis in the late 90s. And after the East Asian crisis, you see that a lot of global South economies, emerging economies, developing emerging economies, whatever you want to call them, have been hoarding foreign currency reserves. Now, this has been happening because there is now plenty of evidence, empirical evidence, to show that a strong reserve position allows you to ward off currency-related crises. But what has also been happening is that for many developing countries, this imperative causes them to channel funds away from development and domestic spending into foreign exchange reserves and debt servicing. Now, this is also closely related to this concept of original sin, which is it's obviously from the mainstream literature, and it has to do with how countries become indebted essentially because they can't borrow in their domestic currency. It's when they can't borrow in their domestic currency, they become indebted in a foreign currency, and that is the cause of all sorts of constraints in the management of their interest rates, exchange rates, and so on. Now, I'm particularly interested in high interest rates because they play a very key role in credit constraints. So reserve accumulation pressures, like we just discussed, make governments prone to borrowing from the domestic financial sector. Now, this emerges essentially because governments in poor countries like Pakistan are not able to meet their revenues from their that not able to sort of get domestic taxation to meet their revenue targets. So there is a shortfall, there's a budgetary financing gap, and they need to borrow as a result from the domestic banking sector. And the reserve accumulation pressure has to do with this because a lot of what they gather also goes into reserve accumulation. It also goes into debt servicing. And this budgetary finance creates inflationary pressures because essentially banks are printing money, they're increasing the money supply, and they are sort of pushing the price level upwards. Now, banks are likely to maintain high interest rates in this sort of environment, not only because of inflationary pressures, but also because they have to maintain the value of their currency. So the reserve accumulation imperative over here operates in two ways. It creates inflationary pressures because it restricts governments from spending on development, but the reserve accumulation imperative also causes or also compels central banks to maintain the value of their currency by keeping interest rates quite high. Now, this is captured quite well in this emerging concept of subordinate financialization. So there's a Marxian literature to this, but the work by Kaltenbrunner, for instance, on currency hierarchy relates quite closely to this as well. The key idea is that countries in the global south encounter financialization from a subordinate position. So there are, of course, various discussions on financialization through international banks that enter global south countries and so on, and the practices and networks and so on that are formed as a result. But the subordinate financialization is specifically about how there's an asymmetry in how countries in the global south encounter financialization. So reserve accumulation is one part of this mechanism. Now, government borrowing, and this is a secondary point, obviously, but this relates to our earlier observation of inflationary pressures. Government borrowing also means that banks would rather lend to the government than to the private sector. And I'm just going to go over this or how this works or what the implications of this are in the case of Pakistan. Now, the case study obviously is about Pakistani banking. So here are a few select graphs. So one of these is just to sort of break this apart for you. This is to show how banks earn interest. Now, normally banks earn interest because they lend, and if you borrowed from a bank, you have to pay interest on that loan. But interestingly, over here, you see that a large part of the interest component for mainstream banks. And by mainstream, I mean banks that are not inclusive finance. So commercial banks is another word to use, but mainstream is the banking sector in general that follows the traditional model. So you can see that most of their interest earning comes from investments, and these investments are in government paper. So what this means is that this shift in the banking model that occurs as a result of these various factors: reserve accumulation, imperative, currency hierarchy, and so on, and more closely government borrowing, sees them relying more on investments and less on loans and advances. And when loans and advances become a less important feature of the banking model, there is lower private credit offtake. You can compare this with how interest is earned for microfinance banks or inclusive finance. Microfinance banks are those that also take deposits. So that's a regulatory feature of the Pakistani system. So not all microfinance institutions can take deposits, but the ones that do take deposits are relevant for us over here. And this is fairly safe to do because they dominate the inclusive finance industry. So about 80 to 90% of the industry is dominated by this sort of model. And over here, you can see that it's a much more traditional approach in the sense that loans and advances are the key drivers of interest earnings. Now, domestic financing gaps in Pakistan can thus be summarized as occurring from weak deposit mobilization. And in the paper, I talk about how this is primarily attributed to a feeble currency. And the feeble currency over here is relevant because when you have a currency that the potential savers regard as unreliable, they're much more likely to save or even speculate in other assets. So that includes land, that includes used cars even. So there is interesting, there are quite a few articles, not journal articles, but if you look up used cars in Pakistan, you'll see that you can buy a car, and in nominal terms, so if you buy a car for say 1 million rupees, a Toyota for instance, it won't really lose much value over a 5-year period. And this is because a lot of other assets become means for saving and speculation. There is of course a lot of speculation in USD, and there have been a number of policy changes directed to addressing this tendency to speculate in US dollars, but also other foreign currencies. Cattle and livestock is another asset which is prone to speculation and a means of saving. Banks also invest in government paper instead of lending because of the structure of the system, but international regulations such as Basel and FATF, the Financial Action Task Force, also support this this tendency to invest in government paper instead of lending. So Basel regulations set restrictions on what the ratios of capital and how you classify capital and who you can lend to. So what that essentially means is that banks are a lot more likely to lend to large corporates than to smaller borrowers, or even SMEs particularly are a problem. The Financial Action Task Force restrictions. So the Financial Action Task Force, for those of you who don't know, is a G7 or G20 body. And primarily its function is to counter money laundering and terror finance. And what this has meant for many countries in the global south is that there are very strong restrictions on who can essentially participate in the banking sector. So you have to submit extensive document as a result. And what this means is that if you're a small enterprise, it's very, very difficult for you to go to a regular bank and get a loan, or even very simply to open a basic account that allows you to carry out some transactions. And this is a key reason why inclusive finance has sort of been designed to overcome these restrictions. And another more basic argument is that high interest rates deter borrowers, and the high interest rates are a very crucial component of the reserve accumulation imperative, which compels countries to maintain their exchange rate. So I think that is, that's more or less it. There is the shadow banking argument is covered quite extensively in the phenomenon of MIVs, which are microfinance microfinance investment vehicles, and also impact investment funds are now heavily involved in microfinance, and that provides an opportunity for them to design instruments that invest in inclusive finance, but that draw in investments from foreign institutional investors. The National Financial Inclusion Strategy lays out how inclusive finance is specifically designed to address the issue of low private sector credit offtake through inclusive finance. This is essentially just this schema that I've drafted to show how the mechanisms actually work. So this is just to summarize really. So the foreign denominated debt issue is one that many countries, particularly Pakistan, are afflicted by. And the issue is not the debt itself, it's the fact that it is foreign denominated. This leads countries to accumulate reserves in foreign currency. And this creates gaps in their budgetary requirements. They must borrow then for budgetary finance. This creates inflationary pressures as the money supply goes up. And simultaneously, not only have interest rates already sort of been placed in this position where they have to be high to support reserve accumulation, but inflationary pressures also cause interest rates to be high. This results in low private credit offtake, and that's why regulators, central banks, and so on have to come up with creative ways to meet these limitations, these credit constraints that arise from this position in the first place. So that is it for now. Thank you for paying attention.